Welcome to the Carol Holman Insurance Brokers webinar on gap insurance. My name is Mark McLaren and I'll be holding the webinar. The agenda for this session is here. We're going to do a recap on what gap insurance does and the sorts of shortfalls that we see when handling claims. We're going to be looking at how we as businesses and consumers are purchasing our vehicles and how that's affecting the growing need for gap insurance. I'll talk you through some updates on the gap insurance world and what's happening out there. And then we're going to look at a couple of products that we offer and look at some claim examples in detail. And then we'll finish off with some of the frequently asked questions that we receive from our brokers. For your CPD, there's a copy of the learning objectives that you'll be able to pull out from attending this webinar. So we're just going to do a recap on what gap insurance is. Basically, gap is there to protect individuals and businesses against a financial shortfall happening following a total loss on a vehicle as a result of an accident, fire, theft, or even flood. So some of the scenarios that we see. Firstly, we see the motor insurer's settlement figure being lower than what the customer has outstanding on their loan. We also see motor insurer's settlement figure being lower than what the termination charge is from the leasing company. We also see motor insurers' settlement figures being lower than the original purchase price of the vehicle. So those three scenarios are clearly highlighting the need for clients to need to find additional funds to cover a shortfall. We're living in a different era. The traditional sticker price that we see on cars seems to be disappearing, and our buying habits have changed. Rather than going down the traditional route of buying a car outright, we're now seeing consumers and businesses being attracted to these sorts of deals that you see on the screen now, i.e. a deposit followed by a fixed monthly cost. It's a perfect scenario really, because you get a brand new car and the finance deals that are on offer put a lot of prestigious vehicles in easier reach from an affordability point of view. And then after a set period, often 2 or 3 years, we can then hand the car back and get a new one. But what we don't think about is what happens if that vehicle is written off. We're living in that subscription economy and buying habits have really changed, and there's less of a need to own things. Netflix that we use, and let's look at this example here, a mobile phone contract. We don't own our mobile phones, we tend to pay a monthly subscription for them. To put that into context with vehicles, a new iPhone could be £40 a month. You can now lease a car for £99 a month with a deposit. And interestingly, of the consumers that take new car finance now, 80% of them are on a personal contract purchase, or a PCP as we call it. And personal contract hire, PCH, is also another funding method and is growing really fast as well. And that accounts for 10% of consumer personal finance. That's ignoring businesses that go down the contract hire route, which we know is a really popular method for businesses to acquire a vehicle. In contract hire, the monthly instalments are at the moment working out cheaper than PCP, which is I think partly why we're seeing some growth in that area. So the way we fund vehicles alone is creating a greater need for a gap insurance policy. And more people are having a financial liability on one of the biggest depreciating purchases that they take on. Contract hire is not designed to be cancelled. And I've got an example of that in a second, But when I mean not designed to be cancelled, I mean a vehicle being written off before the end date of that contract and the customer facing financial penalties as a result. So let's look at this is a real claim that we dealt with, and this is an Audi A3 on a contract hire agreement. When it was written off, the vehicle leasing company calculated that they needed for that vehicle just over £21,000. But they also asked, as part of their termination charge, £4,940 as a result of the loss of hire, i.e. the vehicle not completing its contract and being terminated early because of the total loss. Therefore, the total termination charge from that leasing company was £25,981. The motor insurer, quite rightly, will settle at market value. And in this scenario, the settlement figure was £21,041. They would not cover the loss of hire. So in this scenario, the customer was faced with a fairly significant bill from the leasing company in order to clear that leasing contract with no vehicle. Fortunately, they had lease gap, and lease gap paid that shortfall of just under £5,000. So let's look at some other needs for gap insurance. Motor insurer's valuation takes no consideration of what the customer might have left owing on the finance agreement. And then we move on to the effect of the vehicle up spec. So what we're seeing with people going into PCP or contract hire deals is that vehicles tend to have greater specifications, i.e. they might have some leather seats, special lighting packages like xenon lights, etc. These add to the price of the vehicle, but they also add to a greater depreciation. Because as market value guides such as Glass's Guide don't take into account these specific features and in terms of the valuation. We see a lot of scenarios occur where the customer has written their vehicle off in the first year of ownership and where the motor insurer perhaps should be offering new for old. But quite often we still see a gap claim. Why? Well, a lot of motor insurers' terms say that you must be the registered keeper to benefit from new for old. Well, under contract hire, you are never the owner or registered keeper of the vehicle. The leasing company is. Therefore, new for old wouldn't kick in. And interestingly, one very large motor insurer in the last 12 months has taken the view that that will apply to PCP as well. And when you consider the numbers of people on PCP contracts, that's quite an effect that could have on people who think they've got new for old in the first year. But we also see other claims where the motor insurer offers new for old, but the finance company declines the vehicle. They just want the finance agreement settled. They don't want another vehicle being put on. That means the customer has no choice other than to decline the offer, and the motor insurer reverting therefore to market value settlement, and then a gap claim coming in. Customers can have experiences where the motor insurer says we can give you a replacement vehicle, but the delivery time is 8 to 10 months. Obviously, the customer can't wait that long for their replacement vehicle, and has no other real option other than to accept the market value offer that the insurer reverts to. Gap claim will come in. The other thing that we see or experience is the motor insurer's interpretation of market value, and it can really vary from one motor insurer to another. Some will use Glass's Guide, some will use Parker's, some will use adverts, and some will take an average of those. So it does seem a bit of a lottery as to what the motor insurer will use, and depending on what is used, the customer could find their vehicle being valued lower compared to perhaps another insurer's viewpoint, therefore increasing the gap shortfall. So let's move on to a bit of activity within the gap market. What's happening out there? Well, interestingly, we have seen 2 A-rated insurers pulling out of underwriting gap insurance over the last 12 months. This has had the knock-on effect of some motor dealers reverting to unrated markets. As we all know, dealers that are really successful at selling gap. They actually sell about 30 to 40% of their customers take gap insurance. So when competing against the dealers, it is good for you and the customer to know that our gap products are underwritten by an A-rated insurer. Our claim settlements have gone up. Vehicles are depreciating, and the rhetoric over diesel cars has had quite a big part to play in that, in addition to the upspecking that we see. More technology in vehicles also means that they are harder to repair and are more costly to repair, so we are seeing more write-offs come up as well, coupled with the fact that thefts are on the increase despite advances in vehicle security. 20% of our gap claims arise from theft, and 82% of those theft claims relate to vehicles below £20,000 in value. So that just really does highlight the importance for gap across the spectrum of vehicles in terms of its value, from the small hatchbacks up to the more expensive BMW and Mercedes that are sort of over the £40,000 mark. 82% of light commercial vehicles were stolen without the owner's keys last year. One of the worst culprits for that was the Ford Transit. So it is important for your commercial clients to consider gap insurance as well as your personal lines clients. As you all know, the electric vehicle is a growing area. Nissan Leaf was the fastest selling used vehicle in March 19. The 3 best-selling cars year to date, Ford Fiesta, Vauxhall Corsa and the VW Golf, just shows you that the small hatchback market is so important when considering gap insurance, when they're the 3 best-selling vehicles. And don't forget, let's have a look at the premiums out there. Dealers on average are charging around about £400 for a gap insurance policy. Our average gap premium is coming out around £260, and that's inclusive of 40% commission and IPT. So it's an excellent way to deliver more income into your business whilst still offering great value and choice to your customers. Don't forget, within the online portal there are a large range of gap insurance options for you to consider, from just the single premium policies through to the annually renewable ones that we can offer you now. So let's move on to what I mentioned earlier about the product focus. So this first product we're going to look at is called Combined Purchase Price Protection and Finance Gap. You may have seen it referred to as return to invoice or combined return to invoice cover. That's what the dealers tend to refer to it as. This product is aimed at customers, so commercial customers as well, who are purchasing a new or used. Used is really important because it's just as applicable to used vehicles, car or light van, from a dealer who's selling you the vehicle on finance. This is the most popular product sold by motor dealerships. So how does it work? Well, following a total loss of the vehicle, we're going to pay the difference between the motor insurer's settlement figure and the greater of either the original purchase price of the vehicle or the outstanding finance. Let's look at some examples of how that's working. So again, this is a real claim that we dealt with, and this was a VW Golf that had been owned for just only 2 months. But it had to get taken into the garage to be looked at, and unfortunately the hydraulics failed and the vehicle fell off it and was written off. The purchase price of the vehicle was £6,500 and the customer financed 100% of that. And because of interest, etc., the finance settlement at date of loss was £6,800, so more than what the purchase price of the vehicle was. The news gets worse because then the motor insurer's market value settlement was only £6,000. So in this scenario, combined purchase price protection paid to the customer back to the purchase price of the vehicle, so from the 6 to the 6,500, but also the customer was left still with an outstanding finance, so we gave them an extra £300 to clear the outstanding finance, giving the customer £800 in total, allowing him to walk away without anything owing under the finance agreement. Let's have a look at another one where the finance wasn't the issue. So this was a Ford Fiesta purchased for £16,430. It was 2 years old at the date of loss. The finance settlement, it was on finance, so the finance settlement at date of loss was £9,755. The motor insurer settled out at £10,600, so that was more than enough to clear the finance, but we're paying back to the purchase price of the vehicle under this product, so for here the customer also received from this gap insurance policy £5,830, the difference between the £10,600 and the original purchase price of £16,430. So that put the customer back in a position to be able to go away and purchase a new vehicle. So this particular vehicle, BMW 5 Series, was 14 months old at the date of loss. A nail was flicked up by another vehicle and went through the oil cooler and actually wrote the car off. The purchase price of that vehicle was just under £34,000. The finance settlement at the date of loss was £25,490. The motor insurer's settlement figure was £28,800. So again, the finance was cleared, but again we're paying back to the purchase, so therefore we're paying back to the purchase price of the vehicle. So in this scenario we paid £5,195. And then lastly, this was where the customer didn't have any finance on the vehicle, and therefore the broker sold them purchase price protection because there is no finance. So it's an interesting example here just to illustrate the fact that the customer doesn't have to have finance on the vehicle to be eligible for a gap policy protection. So this example was again a used car, 2013 Range Rover, that was purchased by the customer in June 16. This vehicle was stolen from the customer's driveway 2 years later in August 18. So the customer bought the vehicle for £62,470, bought it outright, no finance at all. The motor insurer's market value settlement after 2 years was £39,340. Very simply, no finance to consider, we're paying back to the purchase price of the vehicle, and as you can see there, this was a substantial claim settlement, then allowing the customer to again go away and purchase another vehicle. Just some other key elements to this cover to make you aware of. You have options when you go into the online system in terms of the cover periods available. You can choose to sell the customer a 1 or 2, 3 or 4 year cover. The best question to ask, one of the best questions to ask the customer is how long are you intending to keep the vehicle for? Normally if they're on finance, their finance will dictate how long they're intending to keep it, but you can tailor the gap product to the length of ownership. One of the questions we get under here with this product is that the customer has a 5-year loan on the vehicle. Under combined purchase price protection, we can offer cover for up to 4 years where we pay back to the invoice price of the vehicle, but we can extend only the finance gap element of the cover to the 5th year. Another question we get is that the broker asks us that their customer's got their vehicle on contract hire. Are they eligible for this combined PPP and finance gap cover? The answer is no. The customer is not the registered keeper or even the owner of the vehicle under a lease, and therefore they could have lease gap is the product to offer someone on contract hire. So let's move on next to our other product focus, which is fleet gap. Our brokers are being really successful in offering fleet gap to their clients and are seeing a 91% retention rate on fleet gap renewals. It's a really popular and growing product for commercial clients. Let's just look at some main points about this cover. It's designed to cover all the vehicles on the fleet, not just those on lease or finance. So it will cover the vehicles. It does pay a benefit for vehicles owned outright. It's annually renewable. It can also cover directors or personal vehicles insured under the motor fleet. We will do short period quotations. So if you're looking for a common renewal date, we can do that as well. And this product is designed to cover cars, commercial vehicles up to 44 tonne. So what are the benefits of this cover? Well, in the event of a total loss, Fleet Gap is going to pay the outstanding amount owing to the finance or leasing company, or it's going to increase the motor insurer's total loss settlement figure by 25%, whichever is the greater. So if you've got a vehicle that's owned outright, that's on your fleet, and that's written off, there will be no finance shortfall for us to consider. So what we will do though is we'll increase the motor insurer's settlement figure by 25%. Maximum sums insured do apply. It's a really easy product to administer. There's no need for you to create another presentation into us for a quotation, and it really does add value to your client's current insurance portfolio. So let's have a look at a claim under our Fleet Gap policy. So this was a Mercedes Sprinter under a contract hire agreement, and it was 2 years old. Hit a third party in the rear, and the termination charge was 100% of outstanding rentals. The vehicle had 18 months left on the lease. The original value of the vehicle was $34,000, and the early termination charge at the date of loss was £19,547. The motor insurer's settlement figure was $13,000. Leasing company therefore requested an additional payment of $6,500. Fleet Gap paid that shortfall. So let's move on to the next area of what we just want to touch upon, the Consumer Credit Act. And it's worth noting what will happen in the event of a total loss, and considering the Act and what protection there is for limited companies. Well, the Consumer Credit Act applies to private individuals, sole traders, partnerships of up to 3, but what the Consumer Credit Act does not protect is limited companies, local authorities, charities. So under the Consumer Credit Act, if you do have to stop your finance agreement early due to a write-off, you don't have to pay the full amount of interest stipulated in the agreement. There is a statutory rebate. But for businesses on contract hire, that's not the case. And as I mentioned before, contract hire is not designed to be cancelled. And then we have seen cases where 100% of outstanding rentals form part of the early termination charge. And when you consider 70% of businesses will use contract hire to fund vehicles, it's an area to consider. The problem is with contract hire is that we quite often try and get hold of the calculation that the leasing company uses to come up with their termination charges, and that's really difficult. So it's a really big unknown area following a total loss what the termination charge is going to be. We recently did a bit of conducted a review of Fleet Gap sales with a panel of some of our supporting brokers. We wanted to understand why they sold Fleet Gap, and these are just some of the responses we got. One broker said they connected with the risks facing the fleet operators following a total loss. Another felt that the potential termination charges on lease needed to be shared with their clients along with claim examples, and then was successful in selling the Fleet Gap. We've had a number of brokers tell us that it's really added value to that client relationship. And the other thing is that products need to be easy to process. You're busy, and that was interestingly one of the feedbacks we got, in that we don't require a big presentation in order to quote. We do have an online system, which I'll show you in a second. We also asked brokers why have customers bought Fleet Gap from you? Well, one didn't realise their broker offered Fleet Gap, so as much of this is about promoting these products to your client and making sure that they are aware of them, as they're probably not going to ask about them. One client was actually put off Gap because the finance house, the place where the funding was being given on the vehicles, had offered Gap and the price was too much, so the client didn't take Gap. At renewal though, the client purchased Fleet Gap from their broker, so there is no restrictions on when the Fleet Gap product can be offered, provided the vehicles are under 10 years of age. Another client was not aware of the financial exposure that could happen following a total loss, trusts their broker and purchased the policy. This is the online website that you log into and can use for quotations. There, just circled there, is the blue button, which is the online quick fleet quote tool, and by very simply clicking on that, you'll go to this screen here, where you can enter your name, your email address, and very quickly get a Fleet Gap quote in within a couple of minutes maximum. So let's just look at some frequently asked questions we received from brokers that we thought would be useful to share with you. First one is, can gap insurance be offered to customers purchasing a used car? Most certainly yes, and hopefully some of the examples I've shown you today highlight the benefit of gap for used as well as new. And here I've just got a chart here just to show you that this particular customer bought a 2-year-old BMW from a BMW garage in 2016 for £23,400. In 2019, that same car now is worth just over £15,000. So if that customer had bought purchase price protection gap and had written it off in 2019, there would be still a substantial claim to be made in order to take the customer back to the purchase price. So it just shows you the depreciation of vehicles on used cars. The other question we get is, my customer has received a discount on the car. Will purchase price protection gap cover the discount in the event of a total loss? The answer is no. We will only pay back to the price the customer has actually paid for the vehicle. The other question we get is, my customers put down a deposit by trading in their old car. Will purchase price protection gap cover their cost of what they put in? Well, the answer is yes, because effectively the money they've put down, or the trade-in car is effectively money they've put down towards the purchase of the vehicle. So the answer is yes on that one. And then the other one is, my customer is unsure if they have a finance agreement or a contract hire agreement. There are customers out there who quite understandably get confused between finance agreements and contract hire agreements. There are some questions that you can ask the customer in order to try and get to find out which one it might be. So things like, will they be the registered keeper? i.e., are they named on the V5? If they're not named on the V5 and the leasing company is, then it's more likely going to be a contract hire agreement. If it's PCP, then the customer is more likely to be the registered keeper and named on that V5. The other thing you can ask them is, what options will they have at the end of the contract? So for contract hire agreements, Generally speaking, at the end of the contract hire, you have no option to buy the vehicle, you simply hand it back. So if that's the answer, then you're steering the customer more to contract hire. However, the customer has the option to buy the vehicle at the end of the 2 or 3 or 4 year period. It could well be that that's a PCP contract. If you're unsure, please contact us and we can certainly help you. We don't operate a large call centre, so you can contact us directly and we can help you with those sorts of inquiries straight away. My customer has not got a finance agreement. Is GAP still worth it? So there is sometimes a misunderstanding thinking that GAP's only applicable if there's finance on the vehicle. I think I mentioned that earlier in my presentation. Yes, GAP is still very much applicable to someone who has not got finance on their vehicle. So there's just some learning objectives and a reflective statement for you to take away with you following today's webinar. I really hope you've found it interesting, and if you have any questions about this webinar or any questions about a GAP policy and need some assistance, please don't hesitate to contact us. Thank you very much for listening.